So we'll be looking at how to prepare financial statements and the relevant notes. The function of an accountant is not complete without the ability to preparing financial statements and relevant notes. You will agree with me that by default, the standard that talks about how to prepare or the component of financial statements preparation is IAS 1. So IAS 1 presentation of financial statements emphasize generically what should be the various components of the financial statements. But in terms of contextual content of those statements, the standard didn't speak much to that. So from industry to industry, what you see as content of each of the components of the financial statement may differ from sector to sector, right? And it will also be very important to stress that as accountants, we should not just be eager to preparing financial statement, but have a good grasp of fundamental knowledge required for those statements. So when I say fundamental knowledge, I'm referring to good understanding of the conceptual framework or the financial reporting framework, and a very good understanding of the relevant legal framework that has impact on the business or the client or the company you are preparing a statement, and also a fair understanding of the regulatory requirements and expectation of such company operating in any specific industry. Say, for example, if I want to prepare the financial statements of a company that operates in the insurance sector, I need to know what are the general financial reporting frameworks as relating to preparation of financial statement generally. I also need to know the peculiar standards, the accounting standards that will or could impact the various components of the financial statement I'm preparing. The standard or each of those standards gives clear prescriptions to various accounting treatment of various scenario or accounting issues. I also need to have a good understanding of what is expected of any company operating within the insurance sector as far as the law is concerned. So when I mean the law, I'm referring to at least or to starting with the Companies and Allied Matters Act. Then by extension too, I need to have a fair understanding of the relevant provisions of the, as stated in the Insurance Act, the NICOM provisions, or every other circular issued by NICOM from time to time as regards the financial reporting requirements or expectation of entities operating in that industry. One typical development in that sector is the adoption of IFRS 17. Who knows what IFRS 17 is all about? IFRS 17 is all about what?
Insurance contracts.
Yeah, so when is the effective date of the adoption of IFRS 17?
I think it's next year.
Are you sure?
2023.
Are you sure? Are you sure? Who has an opinion? Anybody? Anyone? Hello, anyone? Okay, because of time, the provisions of the standard provide that every company whose operation is imparted or whose IFRS 17 imparts its operation is expected to adhere strictly to IFRS 17 with effects from 1st of January 2023. However, in some specific scenario, early adoption is acceptable. So having said all of that, I think that's the prior explanation will give you an insight into what you should do, how you should think, the thoughts that should be in your mind when you actually want to prepare financial statements. So it's not just like the regular custom of preparing financial statements, but you need to contextually understand what are those laws that could impact on the process of the company and the industry in which the company operates. What are the regulatory provisions with relating to tax, with relating to the regulators' guidelines, with relating to every form of laws and regulations or circulars that could have impact in that sector, right? Then you need to look at the various elements of the accounts that you are to prepare or the statements you are to prepare. What are the recent amendments or repeal to those standards? Or are there any new standard that could have impact on what disclosures and presentation you should have in your financial statements, such that you could be sure that disclosures and presentation in the financial statement is in line with what is expected of the standard. So these are part of the things we'll be looking at today. And even after the class, I will expect that discussion in this respect will continue. You also from day to day need to keep yourself abreast of or familiar with the provisions of every common standards that could have impact on various components of the financial. Say, for example, if you are preparing a financial statement for a company that has inventories, so what is the provisions of IAS 2 with regards to that? If you are preparing a financial statement for a company that has property, plant, and equipment, what is the provisions of IAS 16 concerning that? If you are preparing a financial statement for a company that has material, what do you call it now, rental expenses, what is the provisions of IFRS 16, previously known as IAS 17 concerning that? If your operations is relating to a leasing company, what are the relevant provisions of the standard? Are you to apply IAS 17 or IFRS 16? Which one is to be applied? Then if you are also dealing in an account or preparing an account for an organization that is not into property sales or rentals, but as its primary main of business or source of business, but does that rent building out, sells buildings on occasional premise when the opportunity arises, what will be the relevant accounting standard that should be applied? If you have a company that you are preparing its financial and it decides to segregate some assets, which is not very much relevant to his business needs again, but decide to make it available for sale, what is the relevant standard as relating to IFRS 5 concerning that? If you have an organization that has acquired another, that has a controlling interest in another, what is the provision of IFRS 3, business combination, and IFRS 10, consolidated statement concerning that? So you will agree with me that the expectation and the requirement each time is a function of what is the peculiarity of each standard. What we have seen in practice is very many accountants just prepare financials based on the rudimentary knowledge they gathered in school without aligning disclosures and presentations in the financial statement in line with what the standard has required from time to time. Please, Elizabeth, mute your mic. Abdul Wahab, please mute your mic. So these are some of the things we'll be looking at today. What are those things you should pay attention to as you continue, whether as you do this for your client or if you're still in school as you prepare to be gainfully employed someday. All right, let's look at the following outlines. Preparing financial statements and the relevant notes. We will technically look at mapping an account on what we call ETB, extended trial balance, right? Preparing the income statement from the source of information you have in the extended trial balance. Preparing balance sheets, or what we call statements of financial position. Preparing statements of cash flows, that is IAS 7. Preparing owner's equity statement or statement of changes in equity. What are the objectives of external audits? External audits vis-a-vis internal audits. Then we look at understanding the requirements of the notes. What is the specification or expectation of the standard and the conceptual framework with regards to disclosures in the notes to the account? And organizations and activities of the note, basis for the preparation, summary of the significant accounting policies, use of estimates, completing the statements, financial statements and notes. So having said all of this, we are hoping and very much hopeful that at the end of this session, you would have had a fair understanding and know how the adjusted trial balance is being mapped on the extended trial balance. What do we even mean by extended trial balance? Under what circumstance will you require this? I think I need to stress it at this point that when you render your role as a financial accountant, you probably may use either of these two methodologies. You may have an automated accounting software that you use or the organization use in the preparation of a statement. When that is the case, most important thing you need to know is how to map the account, how to know what account to be debited, what account to be credited. In the report sections of each of those accounting softwares, it will generate automatically the statement of comprehensive income, as the case may be, the statement of profit or loss, or other comprehensive income, as you may choose to call it, statement of financial position, and other relevant statements, right? So the problem with this is that most accountants who are not abreast of the fundamental skill set in preparing these accounts, from time to time may lose touch of why and what should be the composition of how these statements should be prepared. But from time to time, you are expected to update your understanding of what mechanical or the manual way of doing this, such that even if there is an error in the setup or the account setup, there is the accounting software setup, you can easily detect it. The second approach is where you choose to use a semi-automated approach, which I think many organizations, particularly the SME, falls to. That is the adoption of Excel as a tool to actually preparing financial statements. So that's what we'll be deploying today. Maybe in our second semester of this mentorship program, we will train generally people on the use of a number of softwares: QuickBook, Sage, and majorly probably Wave and what do you call it, Zero. These are common softwares at the SME softwares that are on the shelf that we need to know how to use, particularly those who are considering shifting job or changing job from one organization to the other, or those who are newly prospecting for one. So that is what I think we should have at the back of our mind. Then as part of the outline, we should also consider breakdown of the objective of the external audit, differentiating between the internal and the external audit, understanding and stating the requirements of the note to the account. As expected or provided in IAS 1, IAS 1 among the many IAS is one of those standard that talks about what should be the component of our financial statements. So the standard provides that the following should be the components of the statement of, the financial statement. One, the statement of financial position. What do we call the statement of financial position? This is a statement that shows the worth of the business. It contains the assets, the liabilities, and the equities the company has acquired from year to year, right? So if you truly want to know the worth of an organization, what you need to review is the statement of financial position. The second one is the statement of profit or loss and other comprehensive income, or you simply call it statement of comprehensive income. The statement of comprehensive income is a compound name for the two, but when you say statement of profit or loss, these sections of the statement of comprehensive income only reports on incomes or revenues vis-a-vis expenses relating to the primary purpose for which the business is being established. However, there are instances whereby events arising from secondary purpose of being in business may arise. When such arises, the income of expenses or costs crystallizing from these is expected to be disclosed in the other comprehensive income. Say, for example, company ABC is into the business of, let's say, trading computers, right? But after many years, it finds out that the plants that it uses for the day-to-day provision of backup for lights, it wants to, in line with the relevant standard, wants to decide to revalue that very assets. Whether we know that either of these two things could crystallize from the revaluation, right? So if the revaluation results into a value that's higher than the book value, of course, there will be need for an adjustment to be made. Whichever way this comes through, disclosures has to be made, whether a surplus or a deficit has to be made or disclosed on the face of the account. So when things like this occur, they are expected to be displayed or presented in the other comprehensive income. For organization that trades in one currency as different from Naira, other than Naira, there are instances that you might need to translate certain items of an asset or liabilities from one currency into another. In doing this, there may result what we call exchange difference. This exchange difference could be realized or unrealized. It is realized where you have actually traded what the item or the accounting base that is being translated. Say, for example, I have inventory that I've translated from dollars into Naira, but I've eventually sold the inventory. That translation difference arising from that inventory then becomes a realized income. If it's, on the other hand, a loss, it then becomes a realized loss, right? But if, on the other hand, we have translated from one currency to another, but the goods in question or the accounting base being translated in question has not been sold, the gain or losses will then have consequent to that is said to be unrealized. So most of these kind of transactions, when they eventually crystallize, may be disclosed in what we call the OCI, other comprehensive income. Then next to that is the statement of changes in equity. From time to time, shareholders, owners of the business may invest in the business. Sometimes they may claim compensation from the business or make borrowings from the business. So, and the business itself from time to time may accumulate earnings in terms of retained earnings, or may even accumulate retained losses, as the case may be. So it's an explicit statement that actually shows the movement of these stakes in the business is said to be statements of changes in equity. Then we have statements of cash flow. This helps us to put into perspective what is the actual cash profit an organization has made per period, and the profit that have been made in the course of the accounting year. How has it been disbursed? Has it been utilized strictly in the operating activity, or you have some other investment that the organization has made in the course of the year, which we report as investing activity, and those who have provided funds for the business and how those funds have been repaid from period to period will also be showed in what we call the financing activity. So in a nutshell, your statement of cash flow actually gives you, first of all, the actual profit that an organization has made in cash terms. Then two, it also gives you a spread of what activities the organization has used its accounting profits on in generating more wealth. So all of that is expected to be disclosed in a statement of cash flow. Permit me to say that beyond what I've explained, cash flow adds some other very important relevance. It is also one of those accounting ratio analysis, accounting analysis tool, right? There are a lot of ratios analysis and its interpretations that can be made out of that. Say, for example, when the operating activity of a company, net operating activity or net cash and cash equivalent or cash outflow or inflow from an operating activity is negative, what does it mean? When it's positive, what does it mean? The net cash inflow or outflow from investing activity, when it is negative, what does it mean? When it is positive, what does it mean? Then same thing with the financing activity, the net cash inflow and outflow from it, when it is positive, what does it mean? What this is negative, what does it mean? These are some of the other interpretative analysis tools that can be made of the statement of cash flows. But that's not the purpose of our discourse today. What we just want to look at is how is this statement to be prepared? What are the compositions? And when you are doing it, what standard are you adhering to? Then notes to the account, of course, every organization must have what we call its accounting policies. That is, drawing from the general financial reporting frameworks, what are the conceptual frameworks that the company has adopted? So by that we mean the entity concept, periodicity concept, the matching concept. What are those judgments and estimates that has been agreed to be used in the course of preparing the financial statements of the organization? Which among all the accounting standards are relevant to the business process, and which one has been adopted? All of these are provided in what we call the statement of accounting policy. One very relevance of this is that when you pick a financial statement and you are reviewing it, and you observe that certain disclosures and presentation made in the relevant sections of the account does not align with the accounting policy, then auditors may pick this as an exception, because the statement of accounting policies disclosures therein should serve as a guide onto how various presentation and disclosures in the notes will be arrived at. Say, for example, one of the components of the statement of accounting policy is the company's depreciation policy. So if the company has had that, oh, on its plant and equipment, plant and machinery, I meant to say, the depreciation rate should be, say, 25%. And you observe that in the fixed asset schedule, depreciation bearing or estimated bearing was done at another rate other than what has been stated in policy with respect to depreciation, then this is a red flag already. So in your review of what should be the composition of financial statements, take your time. Very many people jettison the disclosures contained in the statement of accounting policy, but they are as relevant as every other component of the financial, because they will give you an insight into how figures, presentations, notes in the relevant sections of the account were arrived at. Then the last one there is note to the account. Note to the account just gives you details of workings that makes up the summarized figures already disclosed in every relevant sections of the account. So these are various things you need to hold in high esteem to be able to show him that you are not just the regular accountant, but he or she that knows what should be done, how it should be done, and why we are doing what we are doing. In preparing financial statement, the following approach are required to preparing a statement of profit or loss and a statement of financial position. So I need to stress it here that preparation of financial statement actually starts with the bookkeeping process. That is, you need to selfly or systematically maintain the various source documents. When I mean source documents, I'm referring to various transactions documents that have been used in the course of the business dealings of the organization. Say, for example, you render services to your clients, you want to make claims of your fee, you need to issue invoices. This invoice is an example of source document. The client has paid the money based on the invoice we've raised on them. They demand a confirmation of the payments made. They need receipts. At one time or the other, you've also had instances where you have to issue one form of source documents or the other. Check stub is an example of one, and so many other vouchers are all examples of the various source documents. From these source documents, various ledgers are extracted, right? If you are using an automated accounting software, say for example, you have a confirmation that the client has paid, you have to issue a receipt. And what's from that receipt, let's say a sum of 10 million naira has been paid into one of your banks. Of course, in the accounting software, you must have created a chart of accounts that shows or recognizes the various banks accounts being maintained by the organization, the various components of their assets, the various components of their liabilities, the various components of their equities, the various components of their incomes, and the various components of their various expenses. I remember that we have taken a class on chart of account before. You probably, for more elaborate understanding in doing this, you probably need to make reference to those videos and the material for such. So we are assuming that you already have a good understanding of how to creating a chart of accounts. And we are also assuming that you have a basic understanding of the double entry principle. We've taken a class on that before, right? So all things being equal, having completed your various ledgers, you balance them accordingly, you are expected to extracting a trial balance. I repeat, if you are using a fully automated accounting software, say QuickBook and the likes, what you will just need to do is to set up your chart of accounts, make the relevant postings, and the various components of the report, statement of profit or loss, name them, will automatically be done. But if you are using a partially automated accounting spreadsheet, such as Excel, you could program the Excel template in such a way that when you make amendments or make inputs into your extended trial balance, everything just flows through. I will show you a typical example of one. So why do we do trial balance? Trial balance helps us to cross-check the arithmetic accuracies in our ledger postings. It also helps in putting to test the correctness of the various double entries that have been made, right? To a very large extent, if you are using an automated accounting software, the likelihood that you could make an error in terms of arithmetic accuracy of account balances is very, very minimal. But of course, there could be errors of wrong postings, posting to the wrong account, and the likes. So a brush through of the trial balance gives you an insight where there have been any visible error that could have affected the trial balance. Of course, there are some errors that you could have made that may not affect the trial balance. How will this be treated? So these are some of the reasons why auditors, in the course of their work, haven't reviewed the various transaction trail or accounting trails. And if they so spot any exception, they could then recommend that adjusting journals be raised, right? We talked about most of these things before, and I believe the knowledge should still be fresh. So the main essence of the statement, that is the statements of profit or loss, is to ascertain. What I mean is that after you must have certified that your trial balance is okay, it's balanced and no errors therein. From there, it then flows to the statement of profit or loss, the statement of financial position, the statement of changes in equity, the statement of cash flows, and the relevant notes. So why do we prepare the statement of profit or loss? To ascertain what is the actual profit in terms of gross and in terms of net that could then be carried forward to the statement of changes in equity. Why do we prepare the statement of financial position? To determine what is the total amount of, what is the financial worth of the business, what is the proportion of the finance provided by the owners of the business vis-a-vis loans or liabilities provided by outsiders. That gives us a lot of insights when we want to do accounting ratios estimate, particularly relating to gearing, to know how geared a company may be. Okay, maybe I should put the question forward. When you say a company is highly geared, what does it mean? When you say a company is highly geared, what does it mean?
Good evening.
Yeah, Elizabeth, good evening.
Good evening. When a company is highly geared, that means the liability is more than, the total liability is more than their assets.
Really? Are you sure? Not necessarily, but you tried.
When did they, okay. Yeah.
Hello.
Good evening, sir.
Yeah, good evening.
Yes, sir. When they say company is highly,
Sorry, hold it for us. Which Elizabeth is your own? I have Ade Keye Elizabeth. Which one is your own?
Amana.
Amana. Oh, yeah.
Okay. When you say a company is highly geared, it means it has more of debt.
In comparison with what?
In its capital structure, it has more of debt in financing.
In comparison with what? It must be compared with something. It has more of debt.
The equity. Yeah.
Okay. Yeah, in our task class, I described this as something. When a company has more of debt in comparison with equity, what do we call it in tax? What is the tax terminology, taxation terminology for it?
Solvent.
No. Solvency is not a tax concern, it's an accounting concern.
Yeah, yes.
Who has it? Well, who knows it? You people, you are not reading your materials. I call it thinly capitalized. That was when we talk about thin capitalization. Do you remember we talked about something relating to thin capitalization in tax? Nobody is responding.
Yes, sir. Yes, sir.
Yeah, so please revise all of this, your materials. You never can tell where questions or discussion may arise that you'll be expected to make a constructive contributions. Right? So in the statement of financial position, which we could call balance sheets, we talk about the current, non-current assets, which are those resources acquired in the past with the intention of retention or retentive use in the business as a tool to generating more economic benefit to an organization, right? So each of these components, you cannot prepare a good or a very sound financial statement if you don't know what is the various classes of non-current assets and the applicable standards. So let's identify some of the components of non-current assets we could likely have and what are the provisions of this accounting standard relation to them. Let's say, for example, when you talk about a non-current asset could be a tangible asset. So if they are tangible in terms of PPE, what is the appropriate accounting standard that you need to understudy and apply in this accounting?
IS 16.
IS 16. What if the non-current asset is intangible? What would be the appropriate accounting standard we need to use?
IS
38.
36 or 38?
38.
38. 36 is impairment.
Okay, what is 36?
Impairment of assets.
Impairment of assets. Sometimes the standard requires you to test assets whether the carrying value has not been, the value of the carrying value have not been eroded. When you are to put that to test, what accounting standard did you use?
36.
Exactly, 36. Sometimes you can see that all these standards I've mentioned now, they are still relating to non-current assets. Are we together? Sometimes the standard requires you to test, to fairly value an asset, whether the value actually reflects what is reasonably or arm's length recoverable. When you are to doing a fair valuation, what is the appropriate standard?
IFRS 13.
IFRS 13.
IFRS 13.
All right, so you can see that now imagine if I have an account to be prepared, and by nature, by reason of the composition of the accounts that has tangible assets, intangible assets, impairment, and there is need to fair value some components of these assets, but I don't have a good understanding of what this standard looks like or what the standard has prescribed that from time to time I should do. Do you think I'll be able to come up with a well or fairly represented or presented financial statement? Of course, the answer is no. So what we want to open your eyes to today is not just how to preparing the financial statement, but the standards you need to go and revise on that would make you or give you an authoritative understanding of what you need to do when you meet an issue at hand. Let me give you another instance, which is practically obtainable. Assuming KCP as a firm owns a building, and part of the building is let out for rental services. KCP as a firm is known to be in the business of professional accounting services and tax advisory services, right? But aside the portion of the building that is used for the day-to-day primary objective, it has the other wings of the building that is being let out. How do we account for that building in the book of KCP?
As investment property.
Give us a description of how we will treat or account for that in the books of the organization. Okay, let me put better light. Okay, you want to say something? Go ahead.
The rental amount will be recognized as revenue.
Before we even come to that, this is what the accountant has done. So tell me whether it is correct. Okay. Assuming the value of the building is 100 million, the accountant has simply recognized the land and building or the building itself as 100 million and subject it to depreciation over the years, over the useful life. Is it correct?
No.
What should be done?
No.
What should be done?
A percentage of that building, the building that is used by the company will be recognized as PPE, while the one that is let out, that is on rentage, will be recognized as investment property.
Okay, that's very correct. But you have proposed this to your management, right? And they tell you that, oh, because you need a professional valuer to value this building and be able to tell you, this is the extent to which relates to investment property, and this is the extent to which relates to regular primary use. But the management is not willing to incurring that cost, the cost of actually valuing or fair valuing that building. What will you do? So this is a typical example of an area or issue that will warrant professional judgment, right? So, and that is what, that is part of the areas where your accounting policies is very, very important and your notes to the account. So we've seen instances where the building, the management is not willing to incurring that cost, particularly because they have no intention to selling the building. So the question is that why will they or why should they actually incurring a cost or incur a cost that will not add to the bottom line, right? So if you decide to report the building as plant and machinery alone, you then need to make relevant disclosures, right? But don't also forget that in that kind of situation, organizations that will not be willing to incurring that cost are more definitely SMEs. Abdulhab, please. Are most definitely SMEs. So a major mistake that most of the accountants does in practice is that FRCN has provided, if your business is an SME, you are not expected to using IFRS in preparing the accounts. There is a simplified IFRS that has been made for SMEs. So most of the time, when accountants are preparing accounts for SMEs, they are using IFRS where what ordinarily they should be using is IFRS for SMEs, right? The difference between them, these haven't been mentioned. It then tells you that you need to embark on another level of review. You need to embark on another level of review to knowing what is really the specification or the provision as contained in the IFRS for SMEs. And how is it different from the provisions of IFRS itself? Right? So these are very, very important things for you to do because These are areas that you probably may be misinforming the public by reason of what you have prepared and you think you have done the right thing. And when the auditors even come around, they might spot some of these things as an exception, which doesn't count well for you. So even as auditors, you definitely need to also watch out for instances where the applicable reportable standard should actually be IFRS for SME, as opposed to each time when we prepare the accounts and we disclose that the account has been prepared in line with IFRS. So you will observe that most of the detailed requirements of IFRS, most SMEs cannot comply with it. So while this standard has not been fully complied with, yet we went further to saying that this account has been prepared in line with the standard. So we need to take caution on some things of this nature. Take caution on things or events of this nature, and we hope that outlook of financials we have subsequently after days will be more representative. So, and current assets, when you have current asset items, what are the standards that will likely impact on your current assets? What are the standards that will likely impact on your current assets?
Inventory, for inventory, IS2.
IS2, very correct. So in accounting for that, you need to do all the tests that IS2 has prescribed, ensuring that your inventory balance are fairly represented or presented. You need to take caution of ensure that you specify the method of inventory management, if at all you have inventory in place. All these disclosures has to be made. Then what other standard could impact on current assets? What other standard? What other standard? Very many composition of the current assets are actually imparted by other standards. Say, for example, the usually would be IS 17, now IFRS 16, could impact on what ordinarily we will have reported as a prepaid rate, right? And some composition of the current asset also qualifies as a financial asset. So the relevant provisions of the IFRS 9 could also have an impact, right? So these are some of the things that you need to pay attention to, and you need to be sure that disclosures made in respect of these are done in the right manner. Some of the provisions you have there, disclosures you have there could also be imparted by IAS 37. What is IAS 37?
Provisions, contingent liability, and contingent assets.
All right, so sometimes you make provision for doubtful debt and all of that. And when you are doing that, you must be sure that it's done in line with the standards. Then liabilities. Liabilities. This could be majorly or materially imparted by IFRS 17, right? And possibly what we call IFRS 9. 1 minute, please. So I believe you have following and having a reformed opinion about what should be the outlook of financial statement when it is expected to be prepared.
Yes, sir.
All right, so Of course, current liabilities, we know the composition, the current assets. Then in preparing the cash flow, basically what many of us know is that this statement is governed by IAS 7, and the standard actually prescribes two methods, which you have to choose either of the two, the direct method or the indirect method. But I put it to you, what method is actually recommended by the standard?
Indirect.
Are you sure?
Oh, direct.
What the standard recommends is actually direct method. Why is it that auditors in practice and very many accountants use indirect method? So you need to double check on this. And there is a caveat in the standard is that if for any reason you have deviated from the provision of the standard, you need to explicitly state why you have deviated and communicate your intention that particular deviation will give room for or will result into a more fairly presented financial statement, right? So, but beyond this, the impact of the statement of cash flow actually helps us to ascertain what is the actual cash profit in terms of cash that an organization has made. So at every point in time, your statement of cash flow your statement of cash flow, the operating segment of it, operating activity of it should always be positive. If this values is actually negative, it means even though the company could have declared or ascertained huge amount of net profits, as the case may be, whether before tax or after tax, if the result of the operating activity is negative, it means the company in cash terms actually made cash losses, right? You need to take cognizance of this. Then at every point in time, that means that at every point in time, your statement of cash flow, the operating segment of it must always be positive. If it is negative, it's a red flag, right? At every point in time, your statement of cash flow, the investing arm of it must always be negative. But when it is positive, what does it mean? When the result of your statement of cash flow, the investment section of it, when it is negative, when it is positive, what does it mean? Anybody?
That means more of assets were disposed of.
But it has a professional meaning. When you see a company A, the investing activity, the result, the net of the period is actually positive. And you see company B, the net is actually negative, which is better. Which do you think is better? Nobody is talking. You guys are all accountants. Most of you are all accountants in your various organizations. You've been preparing this financial, you've not been paying attention to them. What does it mean? Adia?
Highly liquid.
Yeah, Abdul Wahab. What does it mean?
It's my highly liquid, right? Meaning there is enough cash in the company to make use of.
Oh, you mean? No, that's not what it means. Even though it's very close, but that's not what it means.
Liquidity.
Is it over trading?
It's not over trading. Okay, let me ask this way. Which one is right or which one is ideal? Is it a negative value of net cash outflow from investing activity or positive value of net cash inflow from investing activity? Which do you think is better?
Positive is better.
Okay.
It shows that the company have assets.
Okay, somebody said negative is better. Can you tell us why? Khadija, I thought you made mention of that.
Yes, I said it, but I'm not so sure, so that's why I can't give you a wrong.
Okay, so technically, investing activity is the arm of the business that shows how the organization has been using its liquid cash. So at every point in time, if you see an organization with a positive value of investing activity, it means that company is not. Who is this? Nokia 2.3, mute your mic. So what it means is that that company has been very wasteful. They have idle cash that they could have reinvested at a minimal returns, but they did not. But the ones, Nokia 2.3, I will delete you from this training. You are distracting us.
All right, but now you can do.
Please, if anyone distracts us again, I will remove the person from this training. All right, so the ideal thing is that at every point in time, except the organization so choose to intentionally liquidate all of its investments or most of its investments, which it intends to use for another purpose. At every point in time, the returns from investing activity must always be negative. It shows that that very organization is making viable investments or reinvestments. That's what it means. So the ideal one is that it should always be negative, except when you so want to liquidate the investments, maybe to meet other purpose, right? All right, so that being said, that's what you need to know as far as cash flow is concerned. There is direct method and is indirect method. The appropriate standard method supported by the standard is indirect. Yeah, is direct, I meant to say not indirect. So with that being said, we'll also talk about statements of changes in equity. I will show you practically how this is being done. And of course, the intention of external audits, we are already aware or abreast of this. Then we also know what purpose it seeks to achieve. The external auditors seek to making an independent opinion, unbiased opinion on the state of financial affairs or performance of the organization. But before it can do that, it has to obtain reasonable evidence that are not biased and that are objectively gathered to corroborate the submissions, right? We look at internal audits vis-a-vis external audits. Of course, every one of you can make constructive contributions around similarities about that and differences in that. Then understanding the requirements of the note. The note to the financial statements are required and are integral part of the company's external financial statements. Notes to the financial statements are required since not all the financial information can be communicated through the amounts shown on the face of the account. So basically, note to the account gives you more details, sometimes quantitative details on how values, summarized figures in the main body of the account have been arrived at, but most of the time, qualitative details, descriptions or explanations around how certain figures came about and other issues that could have been disclosed or communicated in numbers. And a typical impact of the standard that affect this is IAS 10. You will agree with me that IAS 10 has two different forms of events. Events that are adjusting and events that are non-adjusting. Events that are non-adjusting, whether they are adjusting events or non-adjusting events, most of these explanation and event situations or circumstances that give rise to this will definitely have been communicated in the note to the account, right? Then we talk about basis for preparation of financial statement. Very many of us, we do not understand or pay attention to the very basis in which we prepare financial statement. Every organization that is incorporated and operates in the US or its main office is in the US and has investment across various areas of the continent are expected to using what we call the US GAAP, right? That is the US generally accepted accounting principles, right? Then if you're operating in the EU, you are expected to issue or adopt what we call the EU GAAP. What do we call the GAAP that we use in Nigeria? What is the basis for the financial statement prepared in Nigeria? What is it called? Hello, can you hear me?
Yes.
What do we call the generally accepted accounting principles that is adoptable in Nigeria?
IFRS.
IFRS, very good. Before now, we used to use what we call the Nigerian GAAP. Nigerian GAAP used to be our then standard, statement of accounting standard. But as of today, the GAAP we are using is the IFRS. That is why everything we do, or most of the things we do, are actually teleguided by this standard. So you need to know at every point in time what is the standards or the basis for the preparation of the financial statements you are preparing. If your organization, and this is why very many of us need to expand our knowledge of these standards. What many people know already is the IFRS, but there are quite a number of differences between the composition of the prescriptions of IFRS in comparison with the US GAAPs. So to increase your chance of employability, because we are having many US companies coming or investing into Nigeria, you might get some employment and they'll tell you this is a US owned company and its financials has to be in line with US GAAP. Do you have understanding of it? So it's time that we need to actually revisit that standard and try to juxtapose it with what we have locally, such that if you have a client or your employer is subject to the use of that standard, you will not miss that employment opportunity. Please take note. And for many people that want to travel, it's better, depending on the continent you're going, it's better you start grabbing knowledge of the applicable basis for their financial statements. That is a financial reporting framework they are applying there, so that it makes things easier for you when you eventually get there. So that being said, we've also talked about the summary of the significant accounting policies. Every organization has to state the accounting policies that it has adopted as a basis for the preparation of the financial statement. As part of the accounting policy is you have to make some judgments around various estimates. What is the standard on estimate, accounting policies and estimate? What is the standard on that?
IAS 8.
IAS 8. I'm looking forward to instances where we will do more thorough sessions on each of these standards. I wish we really have the time to looking at, because a lot of things need to be paid attention to, particularly in relation to IAS 8. IAS 8 is one of those topical standards that very many people misinterpret. When you talk about changes in accounting estimates and when there are errors, when there are errors in financials. Okay, let me put a question through to you. You prepare the financial statement, the financial statement has been maybe audited in a particular year, but in a subsequent year when you are coming to doing the audit, you find out that a material error has occurred in some of the components of the financials. Say, for example, the revenue has been overstated, some of the components of the expenses has been understated. What do you do to, what will you do in the subsequent period when after you must have identified this?
You adjust you adjust the previous year revenue or expenses.
So according to IAS 8, contrary to what we used to have in our Nigerian GAAP, how can you compare how such error is to be corrected in the days of SAS and how it is to be corrected in IFRS? Anybody? So you will agree with me why I said that there is still a lot of huge knowledge gap. What Nigerian GAAP earlier, the then SAS says is that the net effect of that error, you just need to pass the adjusted entries on the retained earnings, right? You will just look at to what extent has the revenue be over or understated, to what extent has the costs be over or understated, what is the net effect of it? Just adjust it directly on the retained earnings. But IFRS, particularly as noted in IAS 8, provides that you have to do what we call a restatement or transition of that old uncorrected value to the new one, right? So maybe one of these days we will have a section on that. But if we have to take core standards of that nature, maybe it may be a paid session so that people will take it more seriously, because even as of today, we are having less than 20 that are participating. Meanwhile, on that group, we have over 100 registered for this program. Sometimes a lot of people don't value things that are free. All right, so that's what you need to know about that. Contingent liability, this is now telling you a number of issues or instances that we may be obligated to making judgment or estimates on. Contingent liabilities, bad debt, allowance, depreciation, goodwill, property and casualty insurance loss reserves, revenue from contracts, pension and warranty expenses, and the likes. But before we wrap it all up, I want to share very quickly some of those things, how it is practically done in a semi-automated environment. This for the benefit of some of us who have not been working in an audit firm. For those who have worked or currently working in an audit firm, this will not be strange to you. All right, so look at what I've projected in the first instance. This is what we call extended trial balance. Please confirm if you can see my Excel screen.
Yes.
I can.
Okay, so this is what we call extended trial balance. You will observe that at the very extreme, that is under column B, I have various captions of the elements of the account. So I have PPE, I have, that is assets, I have, you come down, you have equity, you have liabilities and the likes, revenue, then coming down, you have cost of sales, you have expenses, right?
Yeah.
So when you are doing this and you group various captions that should be under it in each of the elements of the account, what you are doing is called mapping or chart of account mapping. So all I need to do is under PPE, what are the various components of the assets that should be there? Have tried as much as possible to identify a number of them. Under accumulated accumulated depreciation, what are the various captions? Under current assets, what are the various captions? Under equity, what are the various captions? Under liabilities, what are the various captions? Under revenue, what are the various captions? Under cost of sales, what are the various captions? Under expenses, what are the various captions, right? When you do that, what you're doing is called account mapping, mapping of the account. Then we now identify what are the various ledger balances in respect of these mapped items to the various elements of the account. So these are the opening balances. We have them, and if you go down, you ensure that both sides of the trial balance is actually equal, right? So that's what we have there. Then what does this opening trial balance mean? This means the trial balance of the closing period in the prior year. So I want to prepare accounts for 2021, say for example, the account of 2020, the balances in the balance sheets there will be extracted and brought into this extended trial balance, right? During the year, these are the transactions that have been done. The debit and credit balances will be technically mapped on the face of this account. If there will be need for any audit adjustment or adjustment generally speaking, based on the reviews that have been done, whether in-house or by external party, we pass the necessary adjusting entries here. At the end of the day, if you look down, the two sides of this should also be the same, right? I'm a bit fast because time is not really on our side. Then we have the closing balance, which is the adjusted closing balance after you have adjusted for the current year balances on the opening balances. And from here, you have the income statement and the balance sheet. Then from this particular ETB is just to give you an holistic view of what is the opening balance during the period, what is the transaction during the year, what are the audit adjustments or other forms of adjustments, what is our closing balances, what is our income statement balances, and what is our balance sheet. This will then be flown or linked to the various notes of the accounts. When I was talking about IAS 8, you can see this note to the account correction of prior year errors. So this very figure you have as stated previously, stated, this was the figures in the accounts before. So what they are saying here is that depreciation charge, which was reported as 2.8 before, was understated by 300,000. So you can see that if it were to be during the end gap, this 300 would just be deducted from would just be adjusted on the retained earnings straight. But IAS 8 provides that there should be that transition, right? That is very, very key. So where are we getting all of these values from? It all flows from the extended trial balance. We probably may need to have an exclusive class also for practical sections of this nature, right? Then other notes of the accounts are also technically linked, but you will see that on the face of the account properly, where we have the statement of financial position, you have the various notes that has been stated. So if I want to see what is the makeup of this 15.4, I will just go to note 10. It gives me the details of what happens in the note 10. So the note 10 is what we call the Ppe Schedule that shows the cost of the various assets in a particular period, the depreciation charge, and the comparative period, and all of that. These are not all the things we can just get done in 1 or 2 hours class, right? But the essence of this class is to open your eyes or draw your attention to other very relevant areas of the account or in the course of preparing financial statement that you need to be aware of. So we have deferred tax. How do we come about this? Is in note 12. We have inventories. How do we come about this? Is in note 23. Trade receivables. How do we come about this? In note 23, Roman figure 2. And every other component of the statement of financial position. Time will not permit me to be too elaborate on all of this. But like I told you, our essence of these groupings of class or mentorship program is to draw your attention to what you need to go and revisit to make yourself a better accountant. Revenue is in note 6, cost of sales is in note 7, other income is in note 6, administrative expenses and all of that. So you can see the profit or loss statement begins from here and ends with profit after tax, right? While the other comprehensive income starts at this section. For this particular year, there were no transactions that could have been presented under statement of other comprehensive income. Then you have statement of changes in equity. I told you earlier that this just reports the movement in the share capital balances, if there were any form of prior year adjustment and retained earnings and other reserves, or other compensations in terms of dividend paid directly to the shareholders, right? So that is being disclosed here and it has comparative figures, right? Then you have the statement of cash flows. The statement of cash flow, you could see the operating activity. I'm sorry, I'm being too fast. Time is not really on our side. You can see at the next period here, this company is having 10.7 as the cash profit. But if you have gone to see the profit or loss, the profit or loss before tax was actually 2.2. So that tells you that this company, accounting profit-wise, it has made loss, but in terms of cash, it has actually been profitable. So if you want to make an investment in a company, don't just concentrate on the statement of comprehensive income. Rather, for you to know how cash profitable the business has been, you need to assess the statement of cash flow. Then we have, you can see the investing activity is negative, meaning that the company is making judicious use of its idle resources, and you have the statement, the financing activities. You have the notes to the accounts telling you about the reporting entity statement of compliance, basis of measurement. It talks about a lot of other issues. How do you arrive at your revenue? What is your policy on income tax? What is your policy on depreciations? What is your policy on financial instruments? Are you adopting, where necessary, the provision of IFRS 9? Do they have assets that could be subject to the provisions of IFRS 9? How do you ascertain your taxes? Are you doing that in line with IAS 12? So we need to look at each company and identify various standards that could have impact on it and make those disclosures as we ought to do. So this is what we need to know today. Time will not permit us to do everything practically, but I believe everyone has identified areas that they need to go and revisit. But should you need practical or thorough training on all of this, you probably may need to private chat us. We could organize that practical section thoroughly for a paid consideration. Any question before we wrap it all up? Any question? Any question?
Good
Any
evening, sir.
question?
Good evening, sir. Good evening.
All right, so I'm back. Any question before we wrap it all up? Who has a question?
Good evening, sir.
Yeah, good very evening.
I've been thinking that US gap and Nigerian gap are the same.
Far from
Maybe
it.
they adopt IFRS.
Nigerian gap is actually SAS. So when you say Nigerian gap, we are referring to SAS. But with effect from 2011, okay, what we use is now IFRS gap, right? Do you understand? Okay. So when you say Nigerian gap, you are referring to SAS. But what we are using at the moment is IFRS gap. And IFRS gap on some disclosure requirements and presentations may be at variance with US gap. Let me give you a typical example. The US gap that talked about inventory. US gap says the recommended method for inventory is LIFO. Meanwhile, in IFRS gap, the recommended method is FIFO. So if you see a financials that is prepared on US gap that has inventory, except there is no inventory balance. You know, when there is no inventory balance, LIFO and FIFO will be at par. But if there are inventory balance, LIFO and FIFO will not be at par. Do you understand? So these are some of the issues that we are talking about. So for you to increase your employability and to expand your professional impact, very many of us have a fair understanding of what this IFRS says, but we need to start intensifying our understanding on what the provisions, what is the presentation requirement as expected in US GAAP. Is that clear?
Yes, sir. Okay, sir.
Yes.
Thank you.
All right. Any other question, please?
Sir, another thing, sir.
Okay.
The financial that you just shared, I think maybe in our next session, maybe you.
I didn't get you. What do you say? I didn't get you
I
very
mean-
well, please.
The slide that was just shared now about the statement of financial statement and preparation of accounting. I think maybe in our next semester, you can bring it up to us.
Okay. We will come up with the outline for the next semester. But I need people to be more reactive to the free sessions. The feedback thus far has not been very encouraging in terms of the population turnout, but we'll see what we can do.
Thank you, sir.
All right. Any other question? Khadija, Elizabeth, do you have any question? Abdul Wahab?
No question.
Francis, Ebuka,
No questions, sir. No questions, sir.
Teni Adeni, Rafiu, Ezekiel. All right, so I believe that, tell me if my assumption is wrong, that you will have at least learned one thing that is new, and you will also have, this session has also opened your eyes to areas that you need to revisit. We need to redeem the gradually lost regard to this accounting profession. Very many people are accountants without a context and value, and that underscores why, that emphasizes why we actually put up this mentorship. So we hope that you are making very best use of all the resources and the time we are sharing together. We'll be wrapping up this very section in another 3 to 4 weeks. In the last 7 weeks, we've been on this, and I really hope that this will be very visibly impactful in your work and in your career pursuits. I wish you all the very best. Hope to see you again. Hope to see you again tomorrow for the next class.
Thank you, sir.
All right. Thank you.
Thank you.
Good night, sir.
Night.
Thank you very much.
Good night, sir.
Yeah, good night.